Hello, in this video I will be giving you a clear look at some of the tools that we use to master this market. I'll be covering the important basics in brief, and let's start with what you see in front of you. This is a chart or charts for the pound yen, one of the tools or one of the forex pairs that we trade. And you see four charts on the right hand side, and four different setups. On the left hand side, this is what I call the delta chart, or the volume according to the bid and ask prices. I have been trading personally. I have been trading price action since 2004. If you take a look at my archived videos, you will see me calling some pressure trades. What I meant by that would be looking at the bid and ask prices before pulling the trigger, which is the best way to confirming your trade. You need to know if you're going long, who's going along with you. Are the institutions are in, or they are going against you. Now, before we do that, let's take a look at our main component, which is the channel. Let's take a look at the channel that we choose, that we trade. Let's pull the smallest channel that we have, which is an indication. This is a trade indication. Before I touch base on the channel, let me share something with you that probably you know by now, being a trader, being somebody who's watching this video. Let's look at the trend. For example, from this point here, where the cursor is. If I'll be slow on that so you can see it, and all the way to the bottom here. You clearly see the trend is down. So saying that meaning that you are taking shorts or selling the market every time it goes to a certain retracement, certain high. What are the points that we have in mind to go short every time the market goes higher? The points are, in this case, depending on your MACD setup, which I cannot go in details now, would be either the middle of the channel, the dotted purple line, or the top of the channel, the dotted or the dashed blue line. So in this case, you would have a short call, sell here, 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 or even before that here. You would have a short call from the top of the channel here. This one would have been, maybe gone against you a little bit, but it will eventually come in your favorite direction. And then top of the channel here, middle of the channel here, another middle of the channel here. This is what we call our down chain channel, which is a constant trend follower. It's a clear direction for you taking certain trades from certain points. That's what I call, in my strategy, that's what I call anticipating the market. We anticipate the market to go to a certain point. Once we get to that point, once the price hits that point, then we shift our vision or our view or the whole attention into reading the tape. What I call this, besides the delta chart, this is the tape. This is where the action is. Numbers of contracts traded on the right hand side, which are the ask price versus, or which is the buying price, versus the numbers of contracts on the left hand side, which is the selling price. For example, if you have a red bracket or a red cell, that obviously means that you have more sellers, 35, than buyers, 22. Here, 102 versus 80. It will change to green if you have more buyers than sellers. In this case, you have equal buyers and sellers, but it's still showing green. However, and the green bars or the green brackets or boxes, you should see more buyers than sellers. 126 here, 118 on the left hand side. Okay, that is still not enough for you to pull the trigger. You need to know, you need to read the numbers, you need to have a clear idea of those numbers and what they mean, which we will teach you throughout our school. You probably now would be asking, why do we have 4 different setups or 4 different charts? As a matter of fact, it's 5. Let me explain one thing here. The on-chain channel will fit on different charts. The charts that we use have different setups, different time frames. Actually, we don't use time frames. We use tick frames. For example, the chart in front of you here, it's a 1597, so 1597 tick chart, meaning each bar, each candlestick here, in this case, each candlestick here carries 1597 ticks. It's not time defined, it's tick defined. Now, I'll go over why we need all these charts. For example, today I had a long-term trade. I had a long-term trade right here. Okay, let me show you. I had a long-term trade. It was middle of the channel, long. It was basically a trade where I wanted to ride the market for as much as I can for a lot of amount of pips. Now the trade was here, the entry was here. Let's assume I missed that trade. How would I catch? Where do I go? It did not come back again. It came back to the middle of the channel once, but it did not come back to the middle of the channel again. So basically I was catching runners, which I call momentum trades, from areas above the middle of the channel. However, if you want to catch it, this area, although it did not touch the middle of the channel to bounce off it, it touched actually. Let me go back. If you go to the 79 tick chart, it touched the middle of the channel there. So although you missed it on the long term, you come to this shorter frame and try and catch it from the bottom of the channel according to your MACD setup. Here it is. Middle of the channel long, middle of the channel long, bottom of the channel long, which was even more powerful trade, and another middle of the channel before that and before that. Okay, so for the same reason, we will have a large frame chart. Here is 987. We would have a medium frame chart, which is 144 tick chart, and we have, sorry, this is 233, and we have a medium size, not that small, but not as small as 79. It's a 144 tick chart. Okay, so we use all of them to determining trades, and you can use it on different instruments or different currency pairs, whether it's the Euro US or the Pound US.